Businesses that regularly distribute a percentage of their profits to a certain category of their shareholders are said to be paying dividends on those companies' stocks. Typically, these businesses have been around for quite some time, have a consistent track record of profitability, and have a history of giving a portion of their profits back to their shareholders. Here are some dividend stocks for growth. Realty Income. Throughout the course of the history of the stock market, Realty Income, a conservative triple net retail REIT, is likely the stock that has been associated with receiving monthly dividends the most. This is because Realty Income is a triple net retail REIT. The firm is so committed to making the monthly dividend company its official appellation that it has filed the term as a trademark in order to protect its rights in the name. Due to the fact that Realty Income is traded in the same manner as a stock, the price of a share of Realty Income is subject to the same market dynamics that influence the pricing of other stocks. On the other hand, it is an investment that functions similarly to bonds, but can only be acquired on the stock market. Its empire of over 11,000 properties, which are rented out to over 1,000 different people, provides it with predictable and recurrent rental income flows. Realty Income is devoted to investing in high-traffic retail buildings that are resistant to economic downturns and, perhaps more importantly, Amazon.com proof. These properties will be able to attract a large volume of customers. Realty Income is possibly the company that comes the closest to being completely secure from the threat of competition provided by Amazon.com and other huge e-commerce companies. This is because Realty Income focuses solely on real estate investments. At the current market pricing, Realty Income provides a dividend of 4.4% to its shareholders. Although this is not a huge windfall, it is much higher than the yield on the general market or on 10-year treasuries, both of which offer a return of 2.8%. The standard by which everything else is measured is the yield on 10-year treasuries. Stag Industrial. Realty Income was extremely close to immunizing itself against the threat of competition posed by Amazon.com. On the other hand, one more business that makes monthly payments, Stag Industrial, is capitalizing on the expansion of internet shopping to its own advantage. The majority of its investments are in real estate that is utilized in the logistics and light manufacturing industries. Do you have any familiarity with those rundown warehouse properties that are situated in close proximity to the airport and are frequently crossed by 18-wheeler trucks? Stag Industrial only invests in and holds properties of exactly this type in its portfolio when it makes real estate purchases. It is positioned to profit from this trend because it is a fact that e-commerce will continue to see tremendous growth in the years to come, and the company is prepared to take advantage of this development. Stag Industrial has a portfolio that handles e-commerce fulfillment or other activities for around 40% of its total space. Amazon.com is the main tenant at Stag Industrial, which has a portfolio that handles Amazon.com as well as other businesses. It should not come as a surprise that there was a noticeable increase in the amount of money transacted over the internet throughout the pandemic. The effects of that increase have to some extent subsided since stores have resumed normal operations, but the trend that can be seen here is pretty evident. This trend can only proceed in one direction. A greater proportion of our purchases are being made online at an increasing rate. In spite of this, there is a significant amount of opportunity for improvement. The data that was provided by the United States Census Bureau indicates that the use of the internet contributes to retail sales that account for less than 14 percentage points of the overall sales volume. Despite the fact that the logistical space is both tremendously competitive and competitively fragmented, the management of Stag has come to the conclusion that its market is worth somewhere in the neighborhood of $1 trillion. To put it another way, it is extremely improbable that Stag will exhaust all of its options in the relatively near future. Gladstone Commercial. It is another rough-and-tumble industrial investment that you might want to consider investing in. In a manner analogous to that of Stag, Gladstone Commercial keeps a sizable inventory of assets that are suited for usage in logistics and light industrial settings, respectively. Its office real estate accounts for around 45% of its overall revenues, while its industrial properties account for approximately 51% of those revenues. Properties used for retail and medical purposes make up the remaining 4%. The portfolio has been able to weather the tremendous volatility that has occurred over the past few years with relatively little difficulty as a result of its high level of diversification. The portfolio of the Real Estate Investment Trust consisted of 131 individual properties. These 131 residences were spread across 27 different states and were rented out to a total of 110 distinct occupants. Since 2012, it has adhered to a method that is both consistent and rigorous in its pursuit of growing its portfolio by an average of 15% each year. The occupancy rate is currently at 97%, and it has never been lower than 95% in the building's entire history. Additionally, Gladstone Commercial has been one of the stocks with the most consistent monthly dividend payments ever since it began paying dividends in January 2005. The company has not missed a single payment throughout this time period. EPR Properties. The COVID-19 epidemic presented challenges for a significant number of property managers and landlords. EPR Properties was one of the rare businesses that were affected in such a specific and one-of-a-kind way. EPR is the owner of a portfolio that contains a wide variety of enterprises, such as movie theaters, amusement parks, ski resorts, eat-and-play assets like Topgolf, and a huge number of other places. Topgolf is one example of the eat-and-play assets that are included in this portfolio. In an era in which maintaining a social distance was the standard, EPR is a company that prioritizes experiences over material things. This is perhaps the worst approach to position oneself in order to succeed during this time period. After the COVID outbreak, the bulk of EPR's properties was closed for an extended period of time, and the number of visitors has not yet returned to the levels it had been before the outbreak. However, the most essential fact to keep in mind regarding EPR properties is that the most challenging periods have long since passed, and the closer people's lives get to being normal, the better the prospects are for EPR's tenants. The most recent terrible days are long since in the past. LTC Properties. LTC is going to face some difficulties in the short future as a result of the pandemic's lingering effects, but the company's prospects in the long run are looking quite promising. The portfolio of LTC, which is a real estate investment trust, is made up of senior living homes and skilled nursing facilities in proportions that are generally equivalent to one another. It should come as no surprise that COVID-19 took a hard stance against this industry. Nursing homes were particularly susceptible to epidemics, and to make matters worse, the residents of nursing homes were at unusually high risk due to the elderly ages they had reached at that point in their lives. Communities for seniors to live in are distinct from other types of housing since the people who choose to live there are typically younger and are able to live independently without the support of medical professionals. Despite this, many people who were thinking about renting an apartment during the outbreak were reluctant to move out of their homes and into a building with a higher population density due to the fear of contracting the disease. These lingering effects will not be eliminated by the next day. In spite of this, senior living communities continue to offer an enticing and active lifestyle alternative to a significant number of elderly people, and this is something that has not fundamentally changed. And home care may be an option for many elderly people who require skilled nursing, but who would also like to receive their treatment in the comfort of their own homes. In the end, there comes a moment when there are very few options available besides the care that is provided in a nursing home. One of these options is the care that is offered in a nursing home. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.